Long bond yields rise in the UK to their highest levels since 1998. Australia's final GDP indicators are weaker ahead of June quarter data later today, and New Zealand's terms of trade hits another record high. That's coming up in our 5 Things in 5 Minutes on Wednesday, September the 3rd. And then in our deep dive interview, ANZ's Kishti reviews how Pacific economies can reduce their infrastructure deficits.
The good news is that the Pacific governments have options to speed up the infrastructure build and narrow the infrastructure shortfall at a faster pace.
But first, in 5 and 5 with ANZ, global markets continued a choppy start to September overnight. UK 30-year gilt yields rose to their highest levels since 1998 at 5.68% on fiscal worries. US stocks were lower as the August ISM manufacturing survey remained in contraction. Gold, however, continued hitting new record highs. It was up 2.1% at $3,590 US an ounce. Here's ANZ Head of FX Research, Majabin Zaman.
Gold tends to do well in an environment where you have lower interest rates because, gold doesn't offer you any yield. Investment flows are pretty interesting for gold. ETF flows have been rising, which again is a positive driver for gold prices. And then again, the current lean around speculative positions suggest that there is more room for additional upside from here in gold.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and the Nasdaq were down about 1%. The yield on 10-year US Treasuries was up 3.8 basis points at 4.284%, while the 30-year was up 6.3 basis points at 4.981% on further worries about Fed independence. West Texas oil futures rose 2.7% to $65.71 US a barrel. The US dollar index was up 0.6%. That saw the Aussie dollar down 0.5% at 65.20 US cents, and the Kiwi down 0.6% at 58.63 US cents. Number 2. In Australia today, the focus is on how the economy performed in the second quarter. ANZ senior economist Adelaide Timbrell says final preliminary data yesterday pointed to a slightly softer print than previously expected.
Government, consumption and investment cancelled each other out in terms of their growth effects. And so public demand will not be adding nor detracting from GDP growth in Q2. Now, we thought it would be adding. So this is weaker than we expected. The second thing that we learned was that net exports are only adding 0.1 percentage points to that GDP growth figure. And we thought it would be more than that. When we look at all the data that we've had over the last week or so, it's either been kind of close to our forecast or a little bit weaker. As a result, we have brought down our GDP forecast for the quarter from 0.6 to 0.4.
Number 3. Staying in Australia, ANZ Roy Morgan consumer confidence rose 2 points last week to 88. Here's ANZ economist Maddie Dunk.
It was really driven by a lift in the time to buy a major household item sub-index. That jumped almost 7 points, and that comes after we saw it touch a 3-month low in the week prior. So a bit more optimism around that retail space.
Number 4. New Zealand's terms of trade hit a new record high in the June quarter as export prices rose and import prices fell. ANZ senior economist Matt Galt says it wasn't all good news though.
On the volume side, export volumes were down, again from high levels, and import volumes were up from low levels. So the overall picture is still a very positive one of the export sector, but the growth impulse might be close to running its course, and domestic demand will need to take over driving growth in New Zealand from here.
Number 5. South Korea's annual inflation rate fell to 1.7% in August from 2.1% in July. That was below expectations. ANZ economist Crystal Tan says a temporary widespread phone bill discount was behind the softness.
Now, this effect should fade in September. We're likely to see inflation return to 2%, which is in line with the Bank of Korea's target. So the August inflation data on its own is unlikely to have a significant bearing on the Bank of Korea's policy rate decision. We continue to see scope for a 25 basis point rate cut at its next meeting in October, as long as house prices continue to stabilize.
Crystal Tan there. Now, in our deep dive interview, ANZ international economist Kishti reviews how the Pacific Islands' infrastructure deficit has shifted in recent years.
Counting demand and supply is a reliable way of predicting turning points in markets, and the infrastructure market is no different. However, measuring infrastructure needs can be tricky. The level of construction over time is not directly determined by any measurable level of demand. So the level of construction in the end comes down to social choices, both in terms of the amount and quality of services a country needs and can afford. So we base our forecasts of Pacific's future infrastructure demand on a recent ADB study. To determine supply, we count the capital programs in government's budgets and private sector plans project by project, sector by sector. The sum of these projects gives us the volume of work coming up or the infrastructure investment pipeline. Now, the difference between infrastructure demand and supply then gives us the infrastructure gap. And our analysis shows that the Pacific currently has an infrastructure deficit, and it is likely going to stay that way over the next 10 years.
What exactly are those infrastructure challenges there that the Pacific has that has contributed to this deficit?
Well, Pacific Island governments face specific challenges in aligning investment in critical infrastructure. Like all governments, they balance competing priorities and a finite pool of resources. New infrastructure investment is often put aside in favor of maintenance of core services. Then you have the added challenge of repairing damage from natural disasters like cyclones, floods, tsunamis, and volcanic eruptions, and from global events like the pandemic, which left a legacy of higher deficits and larger debts. Now, this limits the Pacific government's ability to borrow and to build the infrastructure needed to address the backlog and to stimulate the economies.
What is the size of the infrastructure deficit then, Kishti, at the moment, according to your current analysis? How has that changed since your last analysis?
Yeah, our analysis shows that the Pacific infrastructure investment fell short of demand by $1.1 billion in US dollars in 2024, which is slightly lower than the $1.3 billion we forecast a couple of years ago. However, with new supply coming on over the next 2 to 3 years due to increased development partner support, we see this gap narrowing to a low of $712 million in 2029. Nonetheless, we see the deficit remaining through to mid-2030s. In total, we estimate an infrastructure investment deficit of $11 billion over the next 10 years, that is through to 2035.
And how do you narrow that gap? So what sorts of changes or, updates to infrastructure funding and financing could be required to narrow that gap?
Well, the good news is that the Pacific governments have options to speed up the infrastructure build and narrow the infrastructure shortfall at a faster pace. Now, more private sector participation in capital projects is the key here. Today, private finance for basic infrastructure, such as transport and utilities, has been limited. Local developers are rarely able to fund the share of project costs that most banks require, so they turn to green funds and philanthropic capital. With the current focus on sustainability, there is a growing amount of capital being made available, but issues such as scale, the ability to build a portfolio, limited knowledge of Pacific's green ambitions, and credit risks tend to discourage top-tier investment funds. But work is progressing to address some of these obstacles, so we are hopeful that in future, more direct private sector participation becomes a viable option for the Pacific. Now, the governments can also access green financing for climate mitigation and adaptation projects by using instruments such as green and blue bonds, as well as debt for nature swaps. And they can also embrace the concept of asset recycling, where governments privatize or offer as a long-term lease an existing and income-generating public sector asset and use the funds to build new infrastructure assets.
Kishti Sen there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, September the 3rd. Catch you tomorrow with a review of Australia's June quarter GDP figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.